Hello and welcome to IPO Central on ET Now, and my guest today is Mr. Umesh Uttamchandani, who is the Managing Director at Dev Accelerator. The company is coming out with an IPO which opens on September 10th, closes on 12th, price between 56 to 61 rupees. The company is raising a primary issue of 143.4 crores, and that values the company at a little over 550 crores, and the company is primarily into managed spaces and co-working spaces. Umesh, thank you very much for joining us on ET Now. To begin with, give us a sense of what you do as a company. You are into managed services and co-working space, but I think you look at mainly the tier 2 cities.
Correct. So, thank you, sir. Thank you first of all for inviting me here and sharing our thoughts. So, largely, as you rightly mentioned, we are focused on tier 2 cities, providing managed office space solutions to mid to large size enterprises. Now, these mid to large size enterprises who are looking to consume 100-150 seats to anywhere between 700 to 1000 seats, that's the right customer persona for us that we are looking to onboard. Today, while we speak, we are there across 11 cities, out of which 6 cities are tier 2 cities. So, our major focus is to grow and become much more stronger in tier 2 cities while growing as well.
So, 143 crores you are raising, what is it going to be used for?
So, our primary fundamental has always been that we need to grow much more stronger in tier 2 cities. The entire fund that we are raising from capital markets predominantly is used for capital growth. So, out of 143, 73 crores is utilized for future growth investments. 35 crores we are using for debt repayment, so that it reduces the cost of capital for us, and there is no OFS in the system. We are utilizing this entire capital for future growth perspectives.
So, you have somewhere around 127 crores of debt on the books, right?
Correct.
So, it will come to below 100 crores after the debt repayment.
Correct, sir. That is the target. In fact, we have certain mutual funds and fixed deposit as well, which would reduce or curtail the debt by 55 crores.
Give me a sense of your profitability, because in the last 3 years you've been profitable only in the last 2 years. So, there is no 3 years profitability track record, and even in FY25 the profits was only 1.7 crores while your EBITDA margins were over 50%. So, it seems that you have a very high depreciation policy and interest outgoes which is happening, and that's right. So, what is that policy, and how do you plan to become much more profitable? Because from an EBITDA to PAT, it's a sharp decline for you.
Sure. I think this is an interesting question which I keep on getting it. So, our industry is very much cash flow positive business. So, I will just explain the unit metrics fundamental so that it kind of helps the audience to understand as to how this business model operates. So, we typically take up, so ours is an asset light model. We take up an asset let us say at a price point of 100 rupees per square feet. Our revenue from the customers are anywhere between 240 to 250 rupees per square feet, right. So, that is technically anywhere between 2.4x to 2.5x of rent to revenue ratio. Now, this matrix is very much achieved in tier 2 cities. When it comes to tier 1 cities that we operate, this matrix brings down to 2x. So, our 100 rupees of rental that we do, that generates anywhere between 190 to 210 rupees per square feet of rental yield. Now, from this you can gauge that the margins are significantly higher. Why does not it reflect on the PAT side is because we adopt accounting standard of Ind AS, which essentially means that all the rentals that we have committed to our developers that are projected for the next 9 years, that is the agreement tenure that we sign with them, and then the number is brought down to the present value, which kind of shows in depreciation an inflated value of the rental that we are paying out. So, essentially that is not a cash payout, but it kind of puts pressure on the PAT level. The right way to gauge us, or probably industries like us, is to see what is the cash EBIT that we are able to generate, which is significantly higher in our case.
So, so you need to get the scale before profitability increases, right, in that sense, because it's, if you are going to follow Ind AS rules, as you increase your number of seats, the lease rentals are going to go up as well. Correct. And so the profitability will always remain muted because you are going to do the NPV at the depreciation. Correct. So, how do you increase scale and bring in profitability as well?
So, I mean, apt question, sir. With respect to the PAT numbers, what we have identified is that since we are operating in tier 2 cities, we are still positive at PAT today. When we compare to our peers, we are still making a positive number at a PAT level. which is a significant booster and a positive sign of the fact that we are very much cost conscious with respect to the expenses that we are incurring. Now, there are certain drivers which we already identified, which would increase the PAT numbers significantly higher for us. A, we are going to repay the debt. So, our current payout towards interest annually last year was 16.5 crores, which would come down to anywhere between 6 to 7 crores of time frame, because we are repaying 55 crores from the proceeds of the IPO. That would increase the profitability. That is driver number one. Second, there are certain larger assets which are going to come up in the books in this year and the next financial year, in which we are already consumed, which we have taken longer rent free periods, which essentially means that 36% of my rental payout is not going to be paid in the newer assets that we have signed up in the coming 18 months of time frame. So, that would increase my profitability. Third, there is a asset acquisition model which we have re-engineered, which is a PropCo and OpCo model. From there, we have certain PropCo wealth which would be generated, which would significantly increase our bottom line. These are
so
three
that's
drivers.
Something like other income that will come into your balance P&L,
The
right?
third aspect, the PropCo MCO, would be the other income that would be coming in the balance sheet. So, the challenge for us is to identify such assets on a recurring basis, so that the PAT level kind of continuously stays up.
See, today currently you are looking at investing or putting capex on fitments into these assets, and if I'm not wrong, roughly around 75% of your assets are straight lease assets. So, you are investing on the fitments which is there. But your industry peers have also started moving away from this, moving towards a revenue share method, so that you don't have that issue of Ind AS, which is muting your profitability.
Right. Yeah.
So, are you looking to pivot to a model where more revenue share comes into play, and whatever comes in comes directly into your P&L?
Sure. I think for us, what matters is the quality of the asset that we onboard. We typically onboard grade A assets. Now, when we are onboarding grade A assets, it becomes extremely difficult to get a revenue share model signed off from a grade A developer. Now, these are all, so when you are establishing yourself in tier 2 cities, these are all non-institutional developers and unorganized as well. And when we go up and sign up, let's say 2 lakh to 4 lakh square feet of area, getting a revenue share deal from them doesn't probably kind of fit in the books of theirs. And neither do we probably prefer to kind of take revenue share models when we taking up larger assets, because in our case we have very strong occupancy numbers. Why these occupancy numbers are higher? Because we already have certain set of clients who are expanding along with us. So, when I start a new center, I would have anywhere between 40 to 60% of demand on hand before I start a new center. That essentially means that I am hedging my entire lease liability risk from day one, and that is from the revenue side. Second, on the lock-in that I do with the client, it is higher than the lock-in that I provide to the developer. So, on the developer side, I have 3 years of lock-in. On the customer side, I have 3.5 years of lock-in. So, that hedges my risk liability on the leasing commitment that I am doing to the developer as well. So, for us, it would probably make sense to continue on the straight lease model and become much more stronger in that, and eventually 3 years, 4 years down the line, when the right of use assets become much more effective, there your profitability would probably shoot up extremely higher.
So, what is the depreciation policy that you use for fitment? Is it spread over the lease period of the property, or is it with respect to the client?
So, how we gauge from a business sense perspective, let's say I am approaching a client and we need to set up a center of 20,000 square feet. For that 20,000 square feet, roughly an investment of 4 crores would be made to bring in the client. That is about 2,000 rupees per square feet on carpet area, which essentially means that it is a 1100 rupees per square feet on super built up area. So, 20,000 carpet would be around 35,000 square feet of super built up area. When I bring in that client, and the financial metrics would make sense when I am depreciating that entire asset from a business sense, when I am depreciating that entire asset across the lock-in period. And that is why my ROCE today, when you see, that is 26%, which essentially means that I am bringing in the capital back in less than 4 years of time frame. That is how a business case kind of gets developed before I close in a client. On the accounting side, we adopt the policy that is supposed to be adopted as per the income tax laws.
Which is is it an accelerated depreciation or is spread
It
for
is-
furnitures is 100% or that kind of stuff which is
No,
there?
it is not accelerated depreciation. So within 5 years, typically it gets depreciated.
So if a client stays with you more than 3.5 4 years, is that's when the
Margin
ROI
increases.
starts coming in for you
Correct.
basically.
That's precisely the point, sir. So when the customer continues beyond the lock-in, and that is the phase journey where we are, wherein none of our clients have left out or moved out of our premises. We today enjoy less than 1% of attrition rate for our managed office space client. So that is when the margin kind of shoots.
So what's the expansion strategy? Because you are currently in 11 cities, 26 centers. So how many more cities are you looking at actually, and how many centers?
Sure. So till date, we have grown horizontally. Like I have added every new city probably a quarter or every 2 quarters. So that's where our spread is across 11 cities. And in all these cities, we have anywhere between 30,000 to 50,000 square feet of area. What we are now learning is that we are becoming a local player in all those cities. So we today believe that this is a hyper local sort of a business. That is how we need to approach this. In all these cities, we have started taking and consuming bigger sized assets or the campus sized assets. So now we are taking up 2 lakh to 4 lakh square feet of area in all the cities wherein we have expanded. So now the target would be to grow vertically, wherein till date we have grown horizontally in all these cities. So in 11 cities, we will start penetrating much more deeper, and within those 11 cities, the focus would be on tier 2 cities. That is where we will become much more stronger.
Uttam, Umesh, it was a very interesting conversation with respect to your IPO. Thank you very much for joining us. Your IPO is opening on September 10th, price between 56 to 61 rupees per share, and it's I think the anchor book is on Tuesday, which is today. Thank you very much for joining us on IPO Central on ET Now.